Good morning. Welcome to today's stock market outlook video here at theturtlefollower.com, where we teach you to stop predicting and start reacting to market conditions. My name is Steve, and I hope you guys are having a great day already. We're going to take a look at the S&P futures, the Nasdaq futures, and the Dow and the Russell, and try and get an idea of where the market is, where we think it may be heading, and some key levels to keep an eye on for importance for this coming week. So first here we're looking at the S&P futures, and you can see we've really just been in the range that we've started the year out. All right, we've basically traded between 2,000 on the futures and all the way up to just about 2,100. So about a 100-point range for most of the year. We had that big breakdown in August, then chopped around between 1,850 and 2,000. Sure enough, broke back above it, came back, tested that 2,000 level again, and now I've rallied. So in the U.S. with the Thanksgiving week, there was a shortened week, and the market really didn't do much. It tried to break down. It tried to break down on Tuesday. That didn't happen. Wednesday, we were open for a full day. Thursday was no trading in the U.S., and then Friday, pretty much a doji pattern. But you could see what has happened in the last week or so is just that we've consolidated even a tighter range between 2090 and 2073. So now the question comes is, well, where do we go from here? And at least with the S&P, this just seems to me to be setting up for a potential breakout. All right, so obviously the first sign of that would be a move back over 2100 to at least test this 2115 area. All right, and then see what happens when we get there. On the other side, on the flip side of that, to negate that, I would want to see us start trading and closing below 2075. So those are your two levels really for this coming week: 2075, 2100, about a 25-point range. If we start having acceptance either above or below that range, then that probably indicates some direction, and maybe that the market's not ready to break out just yet. If I had to take a guess, and that's all it really is just a guess because we don't predict, I would say this market's probably setting up to break out higher, especially with the seasonality coming with the Christmas holiday. Market tends to be strong during this last couple months of trading. So again, I would just expect to see, maybe this week start breaking above 2100, testing that 2113 level, and then see how we react from there. But over 2113, you could see the next level, if we go back to the weekly chart, is right around 2130. So we still have a couple resistance points ahead of us on the S&P futures, but understand that we are, at least from my perspective, looking like we're setting up for a breakout higher, because we do have these trend lines in place. Okay, there's a trend line there, there's a trend line here. All right, so everything is still pointing to the upside, and we can always go back and look at the last 3 years on the weekly chart, and this could very well be this run that we had, and now one gigantic, let's just take this, one gigantic consolidation that maybe potentially sets us up for another multi-year run. But one step at a time. Again, I would look for those 2100 and 2075 on the futures as my indication of a potential market direction for the rest of the year. Similar situation in the Nasdaq. All right, Nasdaq 100 futures /NQ in Thinkorswim. And again, you want to take a look at that. You could see that we are potentially just setting up one big giant consolidation after this, again, 3, 4, 5 year run that we've had. So here on the Nasdaq futures, again, we've already have that trend line in place. Here's another trend line consolidating right below, all right, those highs. So you can see here the difference on the Nasdaq is we've already broken the highs. All right, the highs from earlier in the year, we've already broken those. And those were, big area was here around 4,500. We did break out at one point up to 46.57, so call it 46.60. All right, broke out, pulled back, and now we're consolidating right around that level again. So if we zoom in and take a look at this again, let's make this a little bit bigger. And here are the levels, okay? So you're really trading between 4,700 and 46.40, let's call it. All right, so anything outside of that range then starts to put a little bit more pressure on the opposite side, and maybe potentially, takes us a little bit lower where, if we start breaking down, maybe the people that thought we were breaking out start to sell, start to liquidate some positions, push us lower. But I think on Tuesday, this big bar that we've had on both the S&P and the Nasdaq that really reversed and closed back in the range, I think is a strong indication that maybe the sellers aren't as strong as they think they are, and maybe we're going to get a little bit of a pop higher. But you can see here 4,700, the next level is 4,730, and then after that there's really no resistance ahead for the Nasdaq. So Nasdaq set up much better than the S&P, but either case, I think it's making a little bit of a statement that we are consolidating very tightly below these breakout levels, and I think that maybe potentially leads us to the upside. All right, here we are at the Dow. All right, the Dow, a little bit different situation. All right, the highs for the Dow earlier in the year, 18,320. All right, we're trading right now right around 17,800. Remember, these are futures, so it's going to be different than the actual index. So I'm just really basing my stuff off the futures. That's typically how I look at the markets. I don't really look at the index. I like to look at the futures a little bit more. Either way, so we do have some room to the upside here before we even start testing the yearly highs. But what I am concerned about with the Dow is that we are putting in this downtrend line. If I make this weekly chart a little bit bigger, you can see that we do have a bit of a downtrend line in place. We came up, we touched it, had that big, huge week, looked like a reversal signal. Then we had another huge week to the upside. So a lot of choppiness right in here in these 2 weeks. And now we're sitting there right below what has been some strong resistance, right around that 17,900, 17,950. All right, but here we are again, broke out back above 17,256, came back and tested that breakout level. That passed, moved higher, and here we are again consolidating in a very tight range right through here. All right, right below a key breakout level. So again, right now, this key level, this tight range, right between about 17,900 and 17,700. All right, so again, either side of that, where we start to see some acceptance, leads us probably in that direction. But don't forget, you do have some key resistance at 18,000, and then again 18,126, and then again 18,300. All right, so those are a couple areas that you want to keep an eye on for a potential breakout in the Dow. Last one, the Russell. You can see we've been in a range. Looks like the Russell may be getting ready to start moving higher with the rest of the market. So now we're starting to see some acceptance across all four major indices, being the Dow, the Russell, the Nasdaq, and the S&P. All right, so you always want to see some acceptance across the board. But here we are. Russell broke this big downtrend line. All right, had a nice move back up to what was support during most of the year, then became resistance right around this 11,000 or 1190 level. All right, so 1200 became resistance when we broke down. You can see we got topped out of it there. All right, it hit resistance here, moved back, and here we are again. But look at what happened this time, where we came back and hit it the first two times. We had these giant runs. All right, that really went from down here, all right, all the way up to these levels. All right, so that's a big move. Now the difference is we're a little bit higher. We started the run from 1130 about. All right, so it's much easier to break out if you're not pulling back all the way to those lows. So again, I think this is just setting up again to basically say that, you know what, we are potentially looking for a breakout. And here is where we are right now. All right, this level here, and it looks like we're already starting that breakout. So I don't think we're going to see new highs in the Russell this year. I think maybe we come up, we're right around 1200 now. Maybe we get another 100 points out of it or so. If the other markets continue to move, I don't see this as a new breakout. Just understand that you are trading in this, what was an even bigger range than we had in the other three indices. All right, so here's how it started. little bit of a run, which we could really classify now as more of a consolidation, a pullback, consolidation, and now maybe breaking out to the upside. So here we are. It's November 28th. We have a month left in the year. I just don't see us breaking out to new highs in the Russell, even if the other three do. I would say most likely to see new highs, Nasdaq, then S&P, then Dow, then Russell. But again, we'll play it by how it comes. But this is the whole point. Just understand where your levels are, and understand where the market is in relation to that level. And then it kind of helps you justify taking long positions, or maybe if you're at resistance, maybe you want to hold off a little bit, see if you get a little bit of a pullback. Just understand it's essentially a roadmap for success. So with that said, let's take a quick look at some of the sectors. So you'll see here, I do this for the members. I sort these sectors based on performance over the last 30 days, and I have the S&P in here. So there are 6 sectors right now of the S&P that are outperforming. The best outperformer right now are financials. So you want to look at being overweight some financials. You can see financials setting up to potentially break to new highs. All right, they're in this gigantic consolidation between 25 and let's say 23-ish. But right now, we're tightening that consolidation up to potential breakout over 25, breakdown under 24, and then key resistance 25.50. So that's how the financials are setting up. They're along an uptrend, even though they did break down. They are very much in an uptrend short term, and they've been outperforming very well. The other side of it, XLK, which is the technology sector, similar situation. Here's the uptrend in place, and this one's even better because this one, if we can get a breakout in the XLK, we can get a breakout to new highs. All right, so you can see that the resistance here at 44.39. So we're consolidating right below that resistance level. Move over 44.50, and all of a sudden we see new highs. No resistance in place because everybody's a winner. Similar situation with the XLK. The XLY. Here we are. All right, discretionary names. Again, consolidating for most of the year. All right, here's your consolidation. We've consolidated, in this range between 80 and just about 73.50, and here we are now. Again, last month of the trading year. We've had a huge run off the 50-day moving average. We're sitting right against support. But this, again, if the market's going to break out, these are going to be the stocks that are going to run, because don't forget, we're coming into the holiday season. Discretionary names always act better. Disney, Amazon, a lot of the department stores act better. I know some of them have been beaten up lately. But again, these are the ones you want to kind of take a look at, these discretionary names, because spending is elevated. And it's become apparent here. You can see just the straight up move that we have from 77 to 81. So you're not going to get rich on these, but just understand that these are names that you can trade if you don't want to trade in Amazon. If you're looking for a more diversified product, trade these stocks. Trade the spiders, the XLY, XLK, the XLF. All right, they're just as good, and they're a little bit better in limiting risk because they're a diversified product. All right, so here you go, the XLY. XLI, the industrials. All right, again, not looking to break out to new highs, but potentially looking to stair step its way higher into the next range. All right, here's the trend line. You can see consolidating right here, right below 55. And I like to look at these as, again, stair steps. All right, so if it kind of breaks out into one range, maybe it ultimately tests the resistance of that range. So here you go. Maybe looking to get over 55, we come up and test 57. All right, it still has some room to run to the upside. That one's up 4.3% over the last 30 days. The healthcare names. All right, again, sitting right below the 200-day moving average on the weekly chart. You can see that right there. All right, so nowhere near the highs like we saw in XLF, XLK, or XLY, but ultimately we are looking at potentially breaking out over these levels around 72.50 or so, and then getting up into this higher range between 73.50 and 77. And the last one, materials names. These have been beaten down for most of the year, but now trading back above the 50-day moving average. All right, consolidating in this range, maybe looking to kind of set up for a reversal move to the upside coming for the end of the year. But again, not necessarily where you want to be long term, but for the next 30 days or so, maybe you want to look at some of these names. All right, some of these names that have been beaten up, for a better part of the year that now maybe look like they're reversing. If we get a breakout, call it over 46, your stop can be down here around 44. You just, again, maybe you're not trading individual names, but just looking at it for a trade. But just be aware you have the 200-day and some key resistance right here at 46. So those are the sectors that I'm kind of overweighting myself in for the model portfolio. The financials, tech, and discretionary. I know I have a lot of discretionary. One of the other ones is the XLP, which are the staples stocks. They continue to pop up on my list. Again, consolidating for most of the year, but maybe starting to get a little bit of a run going here into the end of the year. A much bigger range between 51 and 48, but still, these are stocks that you want to see work, as consumers just, continue to spend money. So here we are. Again, I hope you guys enjoyed this video. If you haven't already had a chance to take advantage of the 7-day free pass, go ahead, take a shot at that. You'll see all the portfolios I trade, the way I trade them, the trading portfolio, the core portfolio, and members get this weekly watch list, which we're going to add new names to every week. They get that. They get trade alerts sent out every night. So when you guys get these emails and it says, remaining content protected for members, that's usually a trade alert or some kind of trade management that we're doing in one of the portfolios. So again, if you haven't had a chance, I hope you sign up. And if not, have a great rest of the week, and we'll catch you during the week. Take care.